Did you know that each year, FHFA, which stands for Federal Housing Finance Agency, changes or reevaluates the loan sizes around the country based on values, and they potentially, every year, change the maximum amount for conventional conforming loans. This is what you're going to get in this video. I'm going to reveal the details so you know how this applies to you, and you want to wait for it because I'm also going to unveil the pros and the cons of conventional mortgages so you know what is the best decision for you. I'm Jen, by the way, and each week I release 3 to 5 videos and shorts so that you can be educated with accurate and real information, no BS, and make the best decision to find the house that you love. Let's get started. Okay, conventional conforming loans. The reason I say conventional conforming is because conventional loans are a type of loan and they are conforming to Fannie Mae and Freddie Mac limits. Those are the 2 agencies that govern and make lending possible in what we call conventional conforming loans. So you might hear the word conventional loans, you might hear the word conforming loans. They mean the same thing. So write that down for your research. Okay. In the last 29 years that I've been doing loans, I have seen the loan limits in conventional loans increase 18 times. Now, it's not mandatory that they raise each year. The only reason that they go up is because home values are going up. From 2006 to 2016, values in the U.S. were a little bit on the brink. There was something in 2008 called the mortgage meltdown, and that is when, really the only time in my history as a loan officer, 29 years, that values actually started to go backwards, okay? So during this time, they left the conforming balance limit at 417,000. It was stagnant for a long time, but since 2016, it's been going up every single year to match what is going around in the country. This was all actually, the formula was calculated or finalized, this algorithm, this fancy formula was finalized by actually an act that was passed in 2008 called the Housing Recovery Act, HERA. HERA. And here is the formula in case you're interested. It takes the third quarter of the current year, FHFA, which stands for Federal Housing Finance Agency, HPI, which stands for Housing Price Index. So third quarter, which is, right around September to October, minus the prior year's third quarter number, housing price index. And then that's divided by the prior year index. And so that gives them a percentage, and that's how much in percent of values that the market has gone up. In addition, to make it more complicated, they adjust in different counties that are considered high cost, where values are much higher, like think California, New York, New Jersey. Those are usually the most high cost areas. In fact, I'm going to put on the screen for you right now a really interesting map of the United States, and you can see these colors. Like, you're going to see that most of the country is gray, which is kind of the normal. And then you see these little pockets. Okay, the orange areas are high cost areas. So you've got Hawaii, Alaska, Guam, U.S. Virgin Islands. Those are all considered high-cost areas. Then you've got some little pockets in California. I was surprised that there are some pockets in Wyoming, a couple of pockets of counties in Colorado, New York, New Jersey, and even Virginia, y'all. Those are the most high-cost areas. Then in the yellow, you see some more in California, Colorado, Utah, Tennessee, Massachusetts, and then way, way down on the tip in Key West in Florida, there's a high cost area there as well. That's like a medium cost area. And then the rest of us, we're all in the gray area. Okay, so the chart that I'm about to show you about the limits for 2025, what this means is that you can get a conforming loan with low down payment accessible. We're going to go over the benefits in just a minute. These are the max loan limits of what you can do and get a conventional loan. So these conventional loans will go all the way up to 4 units. Anything over 4 units is considered commercial. That's a whole other topic. But if you're buying a multifamily property, whether it's your primary residence and you're going to use rent to offset your payment, or whether you're an investor, just know that you can do a 1 unit, which is single family, or go up to 4 units. That's why the chart has 1 to 4 units on it. So the baseline is $806,500. Last year, it was $762,000, so it's gone up quite a bit. And then if you're in the high-cost area, you can go up to $1,209,000. This is a ton of money, y'all, where you can get a low down payment loan. So check out the graph. I'm also going to put a link to it in the description so you can check it out later on. When you go over these amounts that are on the graph, it's considered a jumbo loan or a non-conforming because it does not conform to Fannie Mae limits. And it's a whole different category. The down payment requirement is higher and the rules are a lot more strict. So that is going to get us to the superpowers of a conventional loan and why conventional loans are like the queen of the universe. Okay, the first real superpower of a conventional loan is that you as a first-time buyer can put down 3%. That's 3%, y'all. Let's say you're buying a $500,000 house. That is $15,000. And it'll go up to all those loan limits. If you're buying an $800,000 house, you can put down as little as 3% as a first-time buyer. Now, of course, you have to qualify for the payment, but that's super cool. Now, for everyone else, when you're not a first-time buyer, you have to put 5% down. And that's still pretty low. You know, there's a myth out there that you have to put down 20% down on a loan, and that is not true. Unless, of course, you're buying like an investment property, a second vacation home. That's a whole different category. But today we're talking and assuming that you're buying a primary residence that is for yourself to live in. So 20% down is kind of a myth for getting into a home as your primary. And one thing about conventional loans that I want to mention, a lot of people are fearful to put less than 20% down because of the PMI, which is private mortgage insurance. You want to hop over to a couple of my videos about PMI. PMI is not necessarily a bad thing, especially when you have a high credit score. PMI is super, super small. There's also ways to waive the PMI when you reach an 80% loan to value. Now, there are some restrictions, so you want to make sure and tune in later to my video about the rules about how to remove PMI on a conventional loan. I'll put it down in the description for you so you can take a look at it later. Okay, back to the superpowers. So, low down payment. The other cool thing about conforming loans is that the higher your credit score, the lower your rate and the lower your PMI if it's applicable. Conforming loans are also lenient on co-borrowers. And some of the other government type loans, which is like FHA, VA, USDA, actually USDA doesn't allow co-borrowers, but non-occupant co-borrowers, like let's say parents or siblings or aunts and uncles are helping you co-sign. Conforming loans are actually pretty lenient, and it doesn't have to be an immediate family member, but they do need to be an established close relation. So you'll probably have to write a letter of explanation about it. But that's one caveat of conforming loans that's a little bit more lenient than some of the other types of loans. In fact, I've got a video about this. You got it. I'll put it down in the description about co-borrowers and who can potentially qualify in case that applies to you. Okay, the other cool thing about conventional loans is that they allow for you to use rental income on the house that you're departing, the house you're leaving behind if you're a current homeowner, to count as rental income to offset your payment on that house or taxes and insurance if you own it free and clear. That is a really, really cool thing. Other types of loans don't always do that. So this is a really important feature, especially when we've been in a low rate environment a few years ago. And a lot of people have a really low rate and they're like, hey, I don't want to get rid of this house. I'm just going to rent it and sell it later whenever the time is right. So cool feature. Okay, income. Conventional is more lenient on averaging income for self-employed buyers. If you have been in business 5+ years, we've got to verify through a license or your CPA that you've been in business for yourself for 5 or more years. you can have 1 year tax return that is reviewed instead of 2. This is huge for some people, so make sure that you talk to your lender about it. The other employment feature that they're really lenient on is gaps of employment. So people have things that happen. They're taking care of sick family, they're going away for pregnancy, they're injured, whatever the reason, people have gaps where they're out of the workforce. Now, other loans are strict about 6 months. You got to be back on the loan 6 months. Not conventional, with an explanation. Of course, it needs to make sense. We just want to know the reason that you've been having the gap. And if it makes sense, we're going to probably okay it as long as we can find some other established work history for you that was stable in the past. So make sure you talk to your lender about that as well, not to fear gaps of employment. Okay, the last superpower is if you're buying a 2 to 4 unit property, in other words, you're going to use one of them as your primary, one of the units, and the other units that are remaining, you're going to get rental income. You can put as little as 5% down on this property. Most investment properties, you've got to put 20% down if you're not going to occupy. But on a multi-unit, you can occupy one of the properties. So that is a cool superpower of conventional loans. Now, I do want to mention some things to be cautious about. So I don't want to end this video without letting you know the things you need to watch out for on conventional loans. If your credit score starts to go below 720, conventional loans are a little bit punitive on the interest rates. So before I mentioned that the higher your score, the lower your rate and potentially PMI, well, it kind of goes the other way when your score starts going backwards. So it's important to know that conventional loans, one thing that is not as sexy is that they categorize your interest rate available depending on the middle score of the lowest borrower. So if you have a co-borrower, let's say a spouse, and their score is higher than yours, we aren't going to use that. We're going to use your lower score middle for the sake of determining the interest rate. Now, that being said, we go in buckets of 20. So like 680, 700, 720, 740. So that's why it's really important to pre-approve as soon as possible before you're looking for a house so that there's time to do some homework. Conventional loans, the credit score is super sensitive to your rate and your PMI that you're going to get. So you want to watch one of my videos that I'm going to link down in the description about how to get your credit score up fast. That's a really great video on how to know, how do I get my scores up? Usually it's in the credit card, y'all. I'm going to give you a hint. If you're above 780, you're in the bling zone and everything is rosy and you've got the very lowest interest rate. The other thing to watch out for is if you've had a prior bankruptcy or foreclosure, conventional is not lenient. If you've had a BK, it's 4 to 5 years that you have to wait to get a conventional loan, depending on the type of bankruptcy that it was. And if it was a foreclosure, 7 years. Now, FHA loans are not that way. So if that applies to you, you want to hop over to my video about FHA loans. I'll link that in the description too. Okay, the other thing, last one, I'm almost done. Seller credits on conventional conforming loans are not as big as other types of loans. So primary residence, 3% of the price, so if the price is $300,000, 3% of that is $9,000, would be your max seller credits that you can get towards your closing costs. None of that can go towards down payment, only closing costs. Now, if you put 10% down, it does increase to 6%, so that's cool. And if you put 25% down, it can increase, wait for it, 9%, y'all. That's huge. There you have it. We've got the new 2025 limits. We've got the pros and the cons of conventional loans. Thanks for tuning in. Tune in each week. I'll talk to you soon.